You know, I've been thinking about something lately. I'm sitting here, well, I'm 94 years old now, and I've spent most of my life watching people try to get rich in the stock market. Most of them failed, not because they were dumb, not because they didn't work hard, but because they were playing a different game than I was. See, that's the thing nobody wants to hear. They think it's about picking the right stocks, timing the market perfectly, finding that next big thing. But it's not. It's about something much simpler and much harder. Let me tell you why 99% of Americans will never beat the stock market and why that might actually be okay. Well, let's start with the truth nobody likes. Most people don't actually want to invest. They want to gamble, but they call it investing. You see, there's a difference, a big one. When I was a young man, maybe 11 or 12 years old, I bought my first stock. 6 shares of Cities Service Preferred, paid about $38 a share. And you know what happened? It dropped to $27. I was terrified, absolutely terrified. My older sister had invested with me, and I felt responsible. Every day I'd check the price, heart pounding, wondering if we'd lost everything. Then it bounced back to $40, and I sold. Felt pretty smart about it, too. Then it went to $200. That taught me something valuable, something I never forgot. See, I was so focused on the price, on the short-term movement, that I completely missed what the company was actually worth. I was gambling on numbers, not investing in value. And that's what most people do today. They're watching screens, checking their phones every hour, getting excited when something goes up 5%, panicking when it drops 3%. That's not investing. That's torture. Real investing, well, it's boring. It's buying something for less than it's worth and then waiting. Sometimes you wait years, sometimes decades. You know, Charlie Munger used to say, our favorite holding period is forever. People thought we were joking. We weren't. Now, let me tell you about compounding. This is the most powerful force in investing, maybe in all of finance, and almost nobody understands it. Not really. I like to think of it like a snowball. You start at the top of a hill, and you've got this tiny little snowball in your hands, maybe the size of a baseball. You give it a push, and it starts rolling down. At first, nothing much happens. It's still small. It picks up a little snow here and there, but it's not impressive. But you keep it rolling, and slowly, very slowly, it gets bigger, then bigger, then something magical happens. That snowball starts picking up so much snow with each rotation that it becomes massive, unstoppable. By the time it reaches the bottom of the hill, it's the size of a house. That's compounding. See, most people give up when the snowball is still small. They don't have the patience. They want to see results now, this quarter, this year. But wealth doesn't work that way. I started investing when I was 11 years old. If I'd started at 22, like most people, even with the same returns, I'd have about 60% less money today. Think about that, 60%. Not because I'm smarter, but because I had an extra decade of compounding. You know what people always ask me, Warren, what's my secret? And I tell them it's time. Time is the friend of the wonderful business and the enemy of the mediocre. But nobody wants to hear that. They want a trick, a shortcut, some special formula. There isn't one. Let me talk about something else, something that trips people up constantly: emotions. See, the stock market is it's almost designed to make you feel things: fear, greed, panic, euphoria. And every time you feel something strongly, you make a bad decision. I remember, I remember 2008 very clearly, the financial crisis. Everything was falling apart. Banks were collapsing. The news was apocalyptic. Every single day, people were terrified. And you know what I did? I bought. I bought Goldman Sachs. I bought Bank of America. I invested in good companies that were on sale because everyone else was panicking. Now, that sounds easy when I say it like this, but in the moment, it felt like the world was ending. My phone wouldn't stop ringing. People thought I'd lost my mind. But here's what I understood, what most people don't understand. When everyone is scared, that's when you get the best deals. When everyone is excited and buying, that's when you should be cautious. It's like Thanksgiving dinner, you see. If everyone's rushing to the table, pushing and shoving to get the best seats, you know the food's probably great. But by the time you get there, all the good stuff is gone. You're paying top dollar for scraps. But if everyone's running away from the table, well, maybe they know something you don't. Or maybe, just maybe, they're overreacting. And that's when you can get a feast for pennies. You know, I've always said, be fearful when others are greedy, and greedy when others are fearful. Sounds simple, but it's incredibly hard to do, because you have to go against your instincts, against the crowd, against what feels safe. In 1999, during the dot-com bubble, everyone thought I was washed up. Buffett doesn't get it, they said. He doesn't understand technology. Well, maybe they were right. I didn't understand most of those businesses, but I understood value. And those companies weren't worth what people were paying, not even close. So I sat on my hands, and I waited, and people mocked me. My returns lagged. Investors were leaving Berkshire to chase tech stocks. Then 2000 happened. The bubble burst. Trillions of dollars disappeared. And suddenly, I looked pretty smart again. But I didn't get smarter. I just stayed rational while everyone else went crazy. See, that's the real secret. It's not about being brilliant. It's about being rational when everyone else isn't. Now, let me tell you why index funds are probably your best bet. I know that sounds strange coming from me, a guy who's spent his whole life picking stocks. But it's true. For most people, for 99% of people, they're better off just buying a low-cost S&P 500 index fund and holding it forever. Don't trade. Don't try to time it. Don't get clever. Just buy and wait. You know why? Because beating the market is hard, really hard. Not because the market is smart, but because you're competing against people who do this 80 hours a week. People with teams of analysts, supercomputers, inside information, and even most of them can't beat the market consistently. So what chance does the average person have? Slim, very slim. But here's the beautiful thing about an index fund. You don't need to beat the market, you just need to match it. And matching the market over 30 or 40 years with dividends reinvested will make you wealthy. I've recommended it to my own wife. When I'm gone, I told the trustee to put 90% of her inheritance in a low-cost S&P 500 index fund. If it's good enough for her, it's probably good enough for you. People always want to know about my mistakes. Well, I've made plenty. Buying Berkshire Hathaway itself was a mistake. It was a failing textile mill. I bought it out of spite because the owner tried to cheat me out of 1/8 of a point. Cost me probably, $200 billion in opportunity cost. Then there was Dexter Shoe Company. Paid $434 million for it using Berkshire stock. The company went to zero. But because I used stock, the real cost was, well, it was over $3 billion by the time the dust settled. You know what I learned from that? I learned that mistakes are part of the game. You're going to make them, lots of them. The question is, can you learn from them? Can you admit when you're wrong? Most people can't. They double down, they rationalize, they blame bad luck or the market or someone else. But if you can't admit you're wrong, you'll keep making the same mistakes over and over. I've said this before, it's better to learn from other people's mistakes, but you'll make your own anyway. So when you do, don't waste them. Learn, adjust, move on. Let me tell you about patience, real patience. See, most people think they're patient. Oh, I held that stock for 6 months, they say. 6 months. That's not patience. That's barely a blink. I bought Coca-Cola stock in 1988, paid about $1 billion for it. Today it's worth, well, about $25 billion. But you know what? If I'd sold it after 6 months, after a year, even after 5 years, I'd have missed most of that. The real money, the life-changing money, comes from holding great businesses for decades, not months, not years, decades. You see, businesses are like trees. When you plant a tree, you don't dig it up every week to check on the roots. You'd kill it. You plant it, water it, give it sunlight, and let time do its work. Same with investing. You buy quality and you wait. Now, people ask me about diversification. Warren, how many stocks should I own? And I tell them, well, it depends. If you don't know what you're doing, own a lot. Own hundreds through an index fund. But if you really understand a business, if you've done the work, studied the financials, understand the competitive advantages, then you don't need hundreds. You might only need a handful. Charlie and I, we've probably made most of our money from about 10 decisions. 10 out of thousands of opportunities. Maybe 10 really mattered. See, diversification is protection against ignorance. If you don't know what you're doing, spread your bets. But if you know what you're doing, concentrate. Put your eggs in a few baskets and watch those baskets very carefully. Of course, most people don't know what they're doing, and that's okay. That's why God invented index funds. Let me tell you something about money, real money, wealth. It's not about what you spend, it's about what you keep. I still live in the same house I bought in 1958, paid $31,500 for it. People think I'm crazy. Warren, you're one of the richest men in the world. Why don't you buy a mansion, a yacht? Well, I'm happy here. This house has everything I need. Why would I want something bigger? See, happiness doesn't come from spending money. It comes from doing what you love with people you love and having enough. Once you have enough, more doesn't really change anything. I've known plenty of rich people who were miserable, and I've known people of modest means who were very happy. The difference wasn't the money, it was whether they needed more or we're content with enough. That's a hard lesson for most people because there's always something else to buy, something bigger, something better. But at some point you have to say, enough, I have enough, and then you're free. You know what's interesting about the stock market? It's a voting machine in the short term, but a weighing machine in the long term. What does that mean? It means in the short term, prices are driven by emotions, by stories, by what's popular. But in the long term, prices reflect reality. They reflect earnings, cash flow, real business value. So if you're focused on the short term, you're just trying to predict the crowd. What will people think next week, next month? That's impossible. But if you focus on the long term, you just need to understand the business. Is it making money? Will it still be making money in 10 years? In 20 years? That's knowable. Difficult, but knowable. Let me tell you about something I call the moat. When you're looking at a business, you want to find companies with wide moats around them. Think of a medieval castle, you see. If a castle has a narrow moat, or no moat at all, it's vulnerable. Any invading army can just walk right up and attack. But if it has a wide moat, filled with water, maybe some alligators, well, that castle is protected. Same with businesses. Some companies have narrow moats. Their competitors can easily copy what they do. There's nothing special protecting them. But the great companies, they have wide moats. Maybe it's a powerful brand, like Coca-Cola. People will pay more for Coke than for generic cola. Maybe it's network effects, like credit cards. The more people use them, the more valuable they become. Maybe it's cost advantages, like GEICO. They can sell insurance cheaper than anyone else. Those are moats, and when you find a company with a wide moat and you can buy it at a fair price, that's when you invest. Then you hold on and let the moat protect your investment. I want to talk about something else, something people don't like to hear. You can't time the market. I mean it. I've been doing this for over 80 years, and I can't time the market. Charlie couldn't do it. Nobody at Berkshire can do it. And if we can't do it, you probably can't either. See, the problem with timing is simple. You have to be right twice. You have to be right when you get out and right when you get back in. Miss either one, and you're worse off than if you just stayed invested. I remember during the financial crisis, people were pulling money out of the market left and right. I'll wait until things settle down, they said. Well, things never really settled down, and by the time they felt comfortable enough to get back in, the market had already recovered most of its losses. They missed it. Sold low, bought high, the exact opposite of what you want to do. So here's my advice. Don't try to time it. Just stay invested. Through the ups, through the downs, through the scary times and the euphoric times. Stay invested because time in the market beats timing the market every single time. You know, people often ask me about what to avoid, and that's actually easier than what to buy. Avoid debt. Seriously. Debt is like a ticking time bomb. When things are going well, you don't notice it. But when things go bad, and they always go bad eventually, debt will destroy you. I've seen brilliant businesses go bankrupt because they had too much debt. I've seen smart people lose everything. Not because they made bad investments, but because they borrowed too much. Here's the thing about debt. It takes away your flexibility. When you're debt-free, you have options. The market crashes, you can buy. You lose your job, you have time to find another one. But when you're drowning in debt, you have no options. You're forced to sell at the worst possible time. You're forced to take the first job that comes along. Debt is the enemy of wealth, so avoid it. Let me tell you a little story. Back in the 1960s, I was running a partnership, and we were doing quite well. But I told my partners, I told them up front, there will be years where we underperform the market, maybe multiple years in a row. If you can't handle that, if you're going to panic and pull your money out, then don't invest with me. Well, some people left, and you know what? That was fine. Because the ones who stayed, the ones who understood what we were doing, they did extraordinarily well. The point is, you need realistic expectations. If you expect to beat the market every single year, you're going to be disappointed. If you expect to get rich overnight, you're going to be disappointed. But if you expect steady, consistent compounding returns over decades, then you'll probably be very satisfied. Here's something nobody wants to admit. Luck matters. I was born in the United States in 1930. I was male, I was white, I had parents who valued education. I won the ovarian lottery. If I'd been born in Bangladesh or in a different era, I probably wouldn't be sitting here worth billions of dollars. Now, does that mean success is all luck? No, but it means, It means you need to acknowledge the role luck plays, and you need to be grateful for the luck you have, rather than just attributing everything to your own brilliance. Because here's the truth. The world doesn't owe you success. The market doesn't owe you returns. You're not entitled to wealth. You have to earn it through hard work, rational thinking, patience, and yes, a little bit of luck. Let me tell you about what I look for in a company. Really look for. First, I want to understand it. If I can't understand what a company does, how it makes money, what its competitive advantages are, then I don't invest. Doesn't matter how hot it is, doesn't matter how much everyone else is making. If I don't understand it, I pass. Second, I want honest management. You can have the best business in the world, but if management is dishonest, you're going to lose money. I look for managers who treat shareholders' money like their own, who make decisions for the long term, not the next quarter. Third, I want a reasonable price. I don't need a bargain, but I need a fair price, because even a wonderful business is a bad investment if you overpay. And fourth, I want a business that's simple. The more complex something is, the more ways it can go wrong. Simple businesses, doing simple things, often turn out to be the best investments. You know what's fascinating to me? How little most people know about investing, and yet how confident they are. They'll spend hours researching which TV to buy, comparing prices, reading reviews, but then they'll put their life savings into a stock someone mentioned at a party, or worse, into something they saw on social media. See, investing requires work, real work. You need to read financial statements, understand the business model, analyze the competition, think about the future. Most people don't want to do that work, and that's fine. That's why index funds exist. But if you're not willing to do the work, then don't pretend you're an investor. You're a speculator, and speculators, well, they usually lose money. Let me tell you something about fear. Fear is natural. Everyone feels it. I felt it when I bought into the financial crisis. I felt it during market crashes. I feel it sometimes even now. But here's the difference. I don't let fear make my decisions. See, fear is useful. It keeps you alive. It makes you cautious. But in investing, fear is often wrong. When everyone is afraid, when the headlines are screaming about disaster, when your stomach is churning, that's usually the time to be greedy. Not reckless, not stupid, but rational. When good companies are on sale, you buy them, even if it feels scary, especially if it feels scary, because the best opportunities always feel scary. I want to talk about something I don't discuss much: regret. You know what I regret? Not the mistakes I made. I've made peace with those. I regret the opportunities I missed, the great companies I didn't buy, because I was too cautious, or too slow, or didn't believe enough. Amazon, Google, I understood those businesses. I saw their potential, but I didn't invest, and that cost me. Well, tens of billions in opportunity cost. But here's what I've learned about regret. It's useless if you just stew in it, but it's valuable if you learn from it. So now, when I see a great opportunity, I try to act faster, be bolder, not reckless, but less hesitant, because the cost of missing a great investment is often higher than the cost of making a small mistake. Let me tell you what I think about retirement. People ask me all the time, "Warren, when are you going to retire?" And I tell them, "Why would I retire? I love what I do. I get to work with people I like. I'm doing something I find intellectually stimulating. What would I retire to?" See, retirement isn't about age. It's about what you do. If you hate your work, then yes, retire as soon as you can. But if you love what you do, why would you ever stop? Now, financially, retirement is just about having enough passive income to cover your expenses. That's it. It's not complicated. If your investments generate $50,000 a year and you can live on $40,000, you're retired. Whether you're 30 or 70, age doesn't matter. The math matters. So build your investments, live below your means, and then you're free. Free to work or not work. Free to do what you love. That's retirement. I want to end with something personal, something I've been thinking about a lot lately. I'm 94 years old. I've been incredibly fortunate, built a company, made a lot of money, had a life full of meaning. But you know what I'm most proud of? Not the money. It's that I got to do what I loved with people I loved for decades. I got to spend my life learning, thinking, problem solving. I got to work with Charlie for over 40 years, my best friend, my partner, and now I get to give most of it away. Because here's what I've learned. Money is a tool. It's not the point. The point is living a good life, being useful, helping others, doing something meaningful. If you can do that, whether you're rich or not, you've succeeded. So, why do 99% of people never beat the market? Because they're playing the wrong game. They're trying to get rich quick when wealth takes time. They're chasing excitement when investing is boring. They're listening to their emotions when success requires rationality. But here's the good news. You don't need to beat the market to be wealthy. You just need to be patient, disciplined, rational. Buy low-cost index funds, invest regularly, reinvest dividends, and wait. Wait 30 years, wait 40 years, and you'll be shocked at what compound interest can do. You won't be the richest person in the world, but you'll probably be financially secure. You'll have options. You'll have freedom. And that's worth more than beating the market. So don't try to be me. Don't try to beat the market. Just be smart, be patient, be rational, and you'll do just fine. I promise you that. Now, go forth and invest wisely. And remember, the stock market is a device for transferring money from the impatient to the patient. Be patient. Good luck.